Welcome to Wealth Forge. Before we begin, please subscribe, like, and share this video with someone who wants to build a stronger financial future. All right, today we're breaking down a topic that honestly just completely paralyzes so many would-be investors, and that's this stubborn idea that you need a literal fortune just to get your foot in the door. Well, today we're going to bust that myth. Let's dive right into this explainer and see exactly how we can start making your money work for you, even if you are starting really small. You know, it's such a common misconception. A lot of people genuinely believe they need thousands and thousands of dollars in the bank to even think about the stock market. But what if you could begin with just $100? Now, let's be totally honest with each other here. That first $100, it's probably not going to make you rich overnight. But it does something far, far more powerful. It absolutely shatters that psychological barrier to entry. It gets you in the game. It helps you build real-world knowledge, actual experience, and most importantly, it kickstarts a consistent investing habit that can snowball massively over your lifetime. So, to take you from absolute zero to making your very first safe trade, we're going to follow a clear roadmap in today's explainer. We'll cover your financial foundation, your goals and risk tolerance, the different accounts and investment types, how to actually make that first investment, and finally, avoiding those super common beginner mistakes. Okay, part 1, your financial foundation. Are you ready? Because before risking a single dollar in the market, we really have to ask some hard questions to make sure your financial house is actually in order. Here's the thing. Sometimes the absolute best investment you can make isn't in the stock market at all. For example, if you have zero emergency savings, taking that $100 and starting an emergency fund is without a doubt your strongest first step. You should literally never invest money that you might need for rent, groceries, or, an unexpected flat tire. Or let's say you're carrying high-interest credit card debt. Paying that balance down gives you a guaranteed, mathematically predictable return, which is way better than just crossing your fingers and hoping for a stock market bounce. But if you've got that emergency cushion and your debt is totally manageable, awesome. You are financially prepared to start researching a diversified investment. That brings us to part 2. Goals and risk tolerance. This is all about the purpose of your money. It's where we give your cash a specific job to do and, quite frankly, test your stomach for market volatility. You really shouldn't just invest because your friends are doing it or because you saw some flashy trend on social media. You gotta give your money a specific job. Ask yourself, what are you aiming for here? Is it retirement? Are you building long-term wealth, saving for a future home purchase, or maybe a child's education? Or are you just trying to learn how the mechanics of investing actually work? Listen, your goal directly dictates your timeline. If you need this cash for a house down payment next year, it really doesn't belong in a volatile market where prices could suddenly drop. But if it's for retirement that's decades away, you have plenty of time to weather the storms. So let's do a really quick mental test right now. How would you react if your $100 temporarily dropped to $80? Would you totally panic and sell it at a loss? Or do you think you could just shrug it off and remain invested? You see, risk tolerance is all about how much uncertainty you can comfortably sleep with at night. Long-term investments have way more time to recover from temporary declines, but if you haven't prepared yourself mentally for that $20 drop, you might end up making a highly emotional and pretty damaging financial decision. All right, part 3, accounts and investment types. Choosing your container. This is where we look at the actual accounts that hold your cash and the specific assets you can pack inside them. First things first, you have to choose your container. On one hand, you've got retirement accounts, things like a workplace 401k or an IRA. These are fantastic for the long haul because they offer some seriously great tax advantages, but they do come with strict rules and hefty early withdrawal penalties. On the flip side, you have taxable brokerage accounts. These offer maximum flexibility. You can pull your money out anytime you want. The trade-off is that your investment gains might create some tax obligations. Honestly, for a beginner starting with just $100 in cash, a standard taxable account is usually the simplest way to get your feet wet without worrying about any of those strict lockup periods. Okay, so what actually goes into the container? Let's decode some of the classic jargon, starting with the big one. A stock simply represents ownership in one single company. If you buy a share, you are literally a part owner of that business. The price just rises and falls based on how well the company performs, what investors expect to happen, and the overall health of the broader economy. It's as simple as that. Now, a bond completely flips the script. You aren't buying ownership here, you are actually playing the bank. You're loaning your money out to a company or maybe a government entity. In exchange, they agree to pay you regular interest payments and eventually return your original cash down the road. But hey, what if you don't want to bet your hard-earned money on just one stock or one bond? Enter the fund. A mutual fund or an ETF basically pools money from a bunch of different investors to buy a massive pre-packaged basket of numerous stocks or bonds. For beginners, this is pretty much an instant superpower. Why? Because it gives you immediate diversification. If one single company in that huge basket stumbles, your entire $100 investment isn't ruined. But wait, what if you want to buy a specific stock or an ETF, and one single share costs $500, but you only have your $100? Enter fractional shares. Guys, this is an absolute game changer for small budgets. A lot of brokerages nowadays allow you to just buy a fraction, a tiny slice of a single share. So with your $100, you could literally just purchase 1/5 of that $500 stock. It opens the door to investments that would otherwise be entirely out of reach. Moving right along to part 4, making your first investment. It's time to hit the buy button. You're prepared, you've picked your account, you know the lingo, so how do we actually execute a trade safely? Well, before you execute anything, beware of a very sneaky hidden trap: fees. Look, when you're starting out with a small chunk of change, a tiny $5 monthly account fee might seem totally harmless. But think about it. That instantly eats up 5% of your starting capital. 5% gone just like that. So absolutely always compare trading commissions, maintenance costs, and advisory charges before you settle on a broker. When you're finally logged in and ready to buy, take a breath. Don't rush it. Step 1. Double-check that unique ticker symbol so you don't accidentally buy stock in the wrong company. It happens more than you'd think. Step 2. Confirm if you're buying a set dollar amount or a specific number of shares. And Step 3. Choose your order type. A market order executes immediately at whatever the current available price is. A limit order, on the other hand, lets you set a strict, hard maximum price you are willing to pay, ensuring you never overpay by accident. Making that initial $100 investment is a massive milestone, but it's really just the beginning. The real magic here is consistency. We call this dollar cost averaging. You start on day 1, then you automate a transfer. Maybe it's just $5 a week or $25 a month. By putting this entire process on autopilot, you completely remove the emotion. You're buying when the market is up, you're buying when it's down, and you are building a powerful, consistent financial habit that can generate massive wealth over time. And finally, part 5, avoiding common beginner mistakes. Let's make sure you don't fall into the same exact pitfalls that derail so many new investors. Consider these your ultimate flashing hazard signs. First up, do not expect immediate wealth. Please avoid anyone who is promising you guaranteed overnight returns. Second, ignore the social media hype and those trendy financial influencers. Third, never ever invest borrowed money, also known as margin. It magnifies your risk and can actually leave you owing debt on top of your losses. Stick to the absolute basics, avoid complex options until you've got some serious experience. And finally, seriously, stop checking your account every single day. Daily fluctuations are completely normal. Staring at them is only going to tempt you to make really bad emotional choices. At the end of the day, the whole thing really boils down to this. Start small, learn continuously, manage your risk, and just remain consistent. Remember, your first $100 is not about magically becoming a millionaire by Friday. It's about taking that first step, developing unbreakable discipline, and pouring a rock-solid concrete foundation that's going to compound for decades to come. So, as we wrap up this explainer, I want to turn it over to you. If you had $100 available to invest today, what would you choose? Would it be A, a diversified fund, B, a fractional share of a company, C, put it into retirement savings, or D, keep it in emergency savings for now? Share your answer in the comments below and let us know why. Your response might just be the exact thing another beginner needs to read as they're learning the ropes. And please, like this video, subscribe to Wealth Forge, and share it with someone who still believes they need thousands of dollars to begin investing. Thanks so much for watching, and we'll see you in the next explainer.